Welcome to this Killik Explains finance video. This time around, 2 ways ISA investors may avoid inheritance tax. Emphasis on the word may and the word avoid. This is potentially perfectly legal. We're not talking about tax evasion here. May, because the second one in particular comes with some tight criteria. So let's take a look at this then. What is the problem? Well, a common complaint, it's one that I've heard several times, is I don't want to give all that money away to the government when I die. I'd rather give it to my children, or frankly give it to anyone other than the government. So here's the problem. Inheritance tax does affect ISAs, basically. It's pretty brutal tax. Inheritance tax is levied on your death estate at a flat rate of 40%. There's no sort of lower rate band with this one. It's usually due within 6 months of the date of death, so that can create a kind of cash flow headache potentially as well. And at the moment, under the current rules, individual savings accounts do form part of your death estate, so could potentially be hit by this tax. So that's something, point one, to understand, that an individual savings account is a great way whilst you run it to potentially shelter investments from income tax, from capital gains tax, but at the moment, it isn't an automatic shelter from inheritance tax. Now, a sliver of good news. So there was a rule change relatively recently which helps anyone planning to basically leave their individual savings account to a spouse or civil partner. And that's this. ISA assets can now be inherited by a surviving spouse. Now, the actual assets within the ISA don't necessarily have to pass from one spouse to another on death, but that doesn't stop them from taking advantage of the additional permitted subscription rule. And this basically gives them, that's the surviving spouse or civil partner, an ISA allowance equivalent to the value of those assets that would have formed part of the death estate. So it allows ISA benefits in effect to be preserved, but this APS, this one-off APS if you like, is not available to anyone else. It has to be a spouse or a civil partner. So beyond that sort of narrow group of people, it doesn't protect anybody else from the possibility that the ISA will form part of the death estate and be hit for 40% inheritance tax. So is there anything else you can do? Now the answer is yes, but it does require a bit of care and it's not without its risks. So a potentially wider solution, what I mean by that is a solution which may solve this problem of APSs only applying to spouses and or civil partners. So there is this thing called business property relief. Qualifying investments include many AIM stocks. So what are we saying here? What we're saying is that if you meet all of the conditions, so if the right asset's been held for at least 2 years before death, then they are potentially IHT exempt. In other words, they don't form part of the death estate, provided certain conditions are met, and those conditions are fairly crucial. Now, qualifying investments at the moment can include alternative investment market stocks, or a lot of alternative investment market stocks, and those are stocks that potentially can be held within an ISA. So you might be able to see the scope here. So the good news for ISA holders is this: AIM shares are now ISA eligible. Now, alternative investment market shares are by definition relatively risky, but you could in theory put up £20,000 worth of them into an ISA in 2017-18. Income and capital gains would then be tax-free, but that's true of any shares potentially held within an ISA. And there's a potential inheritance tax exemption too. That's the one that's not available with standard ISA investments, if you like, provided all the BPR conditions are met. There are quite a few of them. They're quite strict, and the rules can be subject to change at any moment. So you have to keep an eye on it and or seek advice. Now, that's where you need to be careful. AIM investing isn't for everyone. So alternative investment market shares can be small and relatively volatile. So definitely don't have the tax tail wagging the dog. Make sure you're comfortable with the underlying investment before sort of gobbling up the tax relief, as it were. Always a rule of thumb. Liquidity can be variable, spreads can be wide, so know what you're getting into, and the qualification criteria for BPR are strict. So it's pretty vital you know what those criteria are, and you're reasonably confident at the time you pop a share into an ISA that you think it might qualify. Rules can change in the future, so just watch out. Whilst this relief is there at the moment, you need to keep an eye on this space because the government does have a habit of changing the rules. Any questions on what is a fairly complex area? That is the idea of potentially popping alternative investment market shares that may qualify for BPR within an ISA to avoid inheritance tax. Easy for me to say, editor@killik.com. And if you'd like to watch related videos that expand on some of these points a bit more, please go to killik.com/. /learn.